As the world saw one of the worst conflicts unfold in Eastern Europe last week, investors turned to commodity markets to hedge against the growing uncertainty. Moscow's invasion against neighboring Ukraine stunned the markets, with investors selling first and asking questions later. While equities crumbled, crude oil futures topped $100 a barrel mark and gold spot prices breached $1,900 per ounce last Thursday. Aluminium prices too reached all-time highs, while nickel prices are approaching decadal highs. Analysts say this could be just the start of a rally in oil prices, and investors and companies should brace for higher commodity prices over the next few weeks. According to Vandana Hari, founder Vanda Insights, the worst-case scenario is unfolding. Crude's rally may have only just begun, as the full impact on global oil and gas supplies is yet to be seen and factored in. The door to a diplomatic de-escalation is not firmly shut, but it will take some major efforts to kick it open again. Should the Kremlin decide to cut off gas exports to Europe, all the world's gas producers put together do not have the spare capacity to plug the gap. To put things in perspective, Russia exports about 5 million barrels per day of crude oil, more than half of which goes to Europe and 42% to Asia. As regards natural gas, Russia has the largest reserves of natural gas in the world, but is the second largest annual producer of natural gas after the US. Given all this, the current geopolitical tensions in Eastern Europe may drive commodity prices further up in near future, flaring inflationary pressure. If the standoff between the two countries diffuses and the sanctions stay limited, the economic impact may be limited. Let's go to Sugandha Sachdeva, Vice President Commodity and Currency Research at Religare Broking, to know how the commodities market may play out this week.
This week, commodity prices are likely to witness significant volatility given the geopolitical developments surrounding the Russia-Ukraine crisis. As for the crude oil prices, Russia's invasion of Ukraine is actually driving a lot of global supply concerns in an already tight market. And investors are also bracing for the potential impact of trade sanctions on Russia, which is the third largest crude exporter globally. Last week, we have seen that Brent crude prices have tested levels of close to $105 per barrel, which is the highest level since 2014, before we saw some correction setting in prices. This week, again, we feel that prices are likely to remain underpinned and we are likely to witness buying interest all over again, even though we feel that prices will remain capped at levels of $110 per barrel for Brent crude, while for WTI crude, we are looking at levels of $105 per barrel. At those levels, we feel that the correction is again likely to set in, as US has indicated that it might look at releasing strategic oil stockpiles to address soaring prices. Besides, on markets radar would be talks between US and Iran, and in case there is any lifting of sanctions on Iranian oil sales, that can actually increase global supply by around 1 million barrels per day. So that will actually cool off the sentiments in the market, and that can lead to some correction setting in for oil prices. Apart from that, the focus would also be on OPEC meeting and their production policy, and that would also steer oil price movement going ahead. So in terms of the overall levels, we feel that Brent crude prices are likely to remain supported at levels of $92 per barrel, while for WTI crude, we feel that prices will remain supported at levels of $89 per barrel. And on the higher side, 105 and 110 per barrel are the levels to look for. As of now, inflation has been soaring higher because of the rising commodity prices and the supply side bottlenecks. So that is likely to keep gold prices underpinned. As for the levels, we feel that $18.80 per ounce is likely to act as a very strong floor for prices in the international markets, while in the domestic markets, 50,000 mark is likely to provide a strong floor for prices and can again lead to a lot of buying interest coming in prices. However, on the higher side, $19.65 per ounce is a strong hurdle area for prices, and for the domestic markets, 52,500 is likely to act as a very strong resistance. Unless these levels are breached on a closing basis, further upside is not likely in the immediate short term.
For silver, Sugandha expects the metal to find support at 62,500 rupees and resistance at 69,500 rupees. Coming to equities, the holiday truncated week may remain volatile with global factors acting as the key market triggers. Domestically, auto sales data, services and manufacturing PMI data, quarterly GDP print, and SEBI's new T+1 settlement cycle may also affect trading sentiment.
The trend is down now. So, if market rallies, people who are stuck up will try to exit. Because in last 2 years, almost 100% increase in the new investors, and they have not seen this kind of market. Whenever they bought, they have seen profit. But in the last 3-4 months, they are sitting in loss. And the last 2 days fall, their M2M payment was very high. So there are a lot of messages on the social media that I have to sell my kidney and average my stock. So that is the pressure they have because of the new margin rules which SEBI had a few months back. So they have to pay upfront money to average. Even if there is a shortfall, then they have to recoup. So I think the volatility will continue and the buyers will be downward.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.